There are NEMT operators running 5 vans who barely clear $40,000 a year. Then there are operators running the same 5 vans banking $250,000 annually. Same market, same brokers, same Medicaid rates, completely different outcomes. The difference isn't luck. It's not timing. It's not even capital. The wealthy NEMT operators think differently, operate differently, and build differently than the ones who stay broke. Most NEMT companies operate with 20 to 40% profit margins. The operators at the low end are working 80-hour weeks for poverty wages. The operators at the high end are building wealth assets that run without them. This is Nemiton, and this video breaks down exactly what separates them. By the end, you'll understand the 15 critical differences between poor NEMT operators and wealthy NEMT operators. Operational decisions, financial strategies, and business structures that determine whether your NEMT company stays a job or becomes a wealth-building machine. Some of these will be uncomfortable, but if making $40,000 a year while working yourself to death is comfortable, this isn't for you anyway. Number 1. Poor operators treat their business like a job. Wealthy operators build systems. Poor NEMT operators are the business. They dispatch trips. They handle complaints. They fill in when drivers call out. The business runs because they run it. Wealthy operators build systems. They document processes, create SOPs, and implement software that operates whether they're in the office or not. Their business runs on structure, not hustle. The final test is this: can the business operate for 2 weeks without the owner touching it? If the answer is no, it's not a business. It's a job with extra risk. In this business, clean workflows matter. Smooth operations keep riders comfortable and make life easier for brokers and medical payers. Poor operators create chaos. Wealthy operators create consistency. And that difference shows up in contracts. Brokers reward reliability. They terminate inconsistency. If the operation falls apart every time the owner takes a day off, that operator will never scale past 5 vehicles. Number 2. Poor operators chase volume. Wealthy operators chase margin. Poor operators measure success by trip count. We ran 300 trips last month. Great. Did any of them make money? Wealthy operators measure success by profit per trip. They track costs down to the mile. They know exactly which routes are profitable and which ones are burning cash. They say no to low-margin contracts even when it means lower volume. To figure out your average fare, you really only need 2 things: your costs and your margins. Guessing is what struggling operators do. Successful ones track the numbers. Let's say, for example, that your average cost per trip sits around $20, and you're targeting a 25% margin. That puts your average fare closer to $25. Some operators still accept $22 trips just to stay busy. Stronger operators don't. They reserve that same vehicle time for $30 private pay work. Movement without margin is just overhead in disguise. And in NEMT, the operators running non-stop are often the ones struggling the most. Speaking of margins, if you're not tracking how broker rates change, you're leaving money on the table. Medicaid reimbursement rates shift. Broker contract terms change. New compliance requirements get added. Most operators find out 3 weeks after it happens, which means they've already lost thousands. The Nemiton Intel is a weekly breakdown of everything changing in the NEMT market. Rate updates, broker policy changes, state-specific compliance shifts, all delivered before it costs you money. Wealthy operators stay ahead of the market. Poor operators react to it. Links in the description. Now back to the list. Number 3. Poor operators underprice to win contracts. Wealthy operators walk away from bad deals. Operators who struggle usually compete on price, trimming a few cents per mile to win work. That might keep vans moving, but it almost always leads to maintenance getting pushed off and margins tightening. The operators who do well compete on value. They charge more and support it with better service, strong compliance, and consistent reliability. They don't waste time chasing the cheapest contracts. The truth is, clients who only care about price tend to be the hardest to deal with. Invoices get questioned, claims get disputed, and problems get pushed downstream. Experienced operators understand this. Quality clients pay for quality, and saying no to the wrong work is often what protects the business. Number 4. Poor operators run everything manually. Wealthy operators invest in technology. Excel spreadsheets and group texts. Manual trip assignments. Calling drivers to confirm pickups. Handwritten mileage logs. This is how operations stay small. Meanwhile, someone else is using actual NEMT software from day one. The cost? $50 to $200 per vehicle monthly. That's $600 to $2,400 annually. Sounds expensive until you look at what manual processes actually cost. Manual data entry creates 15% error rates. Those errors cause claim rejections. Those rejections trigger 30 to 60-day payment delays. A single delayed payment on a $10,000 batch of claims costs more than 2 years of software subscriptions. So the real cost is operating without it. Number 5. Poor operators rely on one revenue stream. Wealthy operators diversify income. The operators building wealth don't put everything in one basket. They're working with multiple brokers. Building private pay relationships with dialysis centers, nursing homes, rehab facilities. Offering specialized services, bariatric transport, pediatric care, stretcher services that command premium pricing. For example, private pay clients let NEMT companies set their own rates and pay in full. Facility contracts can be very profitable partnerships. And government programs like Medicaid provide steady client flow, but come with strict quality and compliance rules. So it really comes down to risk. When one broker changes contract terms or loses a state agreement, what happens? If you're diversified, you adjust a few routes and move on. If you're dependent on that single source, you panic. Putting all your eggs in one basket is easier. Nobody's arguing that. But easier doesn't mean smarter. When that basket breaks, the entire operation goes with it. Number 6. Poor operators hire anyone with a license. Wealthy operators build a team. Clean driving record can start tomorrow. That's the entire hiring process for most operations. Someone applies, they have a pulse and a license, they're hired. The operators who are really profitable treat their business like they're running a customer service team, because that's exactly what it is. Drivers are the face of the company, working with patients who are often nervous, anxious, or uncomfortable. So you need to work with someone who really knows how to navigate complex situations with them. Because on the other side, bad drivers cost more than their hourly wage. They cost broker contracts, reputation, future opportunities. One rude driver can lose a $50,000 annual facility contract. Hiring cheaply is expensive. Number 7. Poor operators ignore cash flow. Wealthy operators manage it religiously. Revenue looks great on paper. We brought in $30,000 this month. Fantastic. Now answer the real question. When does that money actually hit the bank account? This is where most operations break down. They're looking at invoices instead of cash flow. They're celebrating revenue they won't see for 90 days. The reality: Medicaid brokers typically process payments 30 to 90 days after service delivery. Some take longer. But driver payroll is due in 2 weeks. Insurance is monthly. Fuel gets charged immediately. The math doesn't work unless there's a cushion. Operators building wealth maintain 3 to 6 months of operating expenses in reserve, ready for all things that could happen. Because you know what? Running out of cash isn't bad luck. It's poor management that caught you by surprise. Number 8. Poor operators skip maintenance. Wealthy operators prevent problems. Poor operators run vehicles until they break. Then something goes wrong in the middle of a dialysis run at 6 a.m. Instead, wealthy operators maintain on schedules. Maintenance costs run $1,500 to $3,000 per month per vehicle. Poor operators see that as optional. Wealthy operators see it as insurance against losing $10,000 in broker contracts when a van dies mid-route. The other layer of that is the budget for vehicle replacement. The wealthy ones don't wait for a van to hit 200,000 miles and start breaking down weekly. They cycle vehicles out at 120,000 to 150,000 miles while they still have trade-in value. Number 9. Poor operators avoid private pay. Wealthy operators cultivate it. Most operators think Medicaid is the entire market. Private pay seems too difficult, so they never try. Meanwhile, private pay clients set their own rates and pay in full without broker involvement. A single dialysis center with 40 patients needing transport 3 times weekly is worth more than 10 Medicaid broker contracts combined. The opportunity is sitting there. Hospitals, nursing facilities, doctors' offices, lab facilities, retirement communities, adult daycare centers. They all need reliable transportation. Leave marketing materials. Build relationships. Offer value-added services like same-day availability and multi-patient coordination. And most critically, in states with insufficient Medicaid reimbursement rates, private pay becomes essential for survival. Broker-only operations in low reimbursement states stay broke by design. Number 10. Poor operators wing it. Wealthy operators follow business plans, starting with a vehicle and a dream. No formal business plan, no financial projections, no competitive analysis, just vibes and determination. This works until it doesn't. The operator's building something sustainable. They're treating NEMT like an actual business. Detailed plans, 24-month cash flow projections, competitor analysis, target market identification, pricing strategies that account for real costs. But here's what most people miss. Passion for the idea means nothing without understanding that businesses require marketing, sales, customer service, and administration. All the parts nobody particularly enjoys doing. The discovery happens around month 6. Suddenly there's a mountain of invoices, broker disputes, compliance paperwork, and payroll issues. The operators who plan for this hired accordingly. The ones winging it are drowning. Number 11. Poor operators ignore metrics. Wealthy operators track everything. Poor operators have no idea what their actual cost per mile is. They don't track on-time performance. They can't tell which drivers are profitable and which ones cost money. They operate on gut feeling. Big mistake. The operators making money run data-driven operations. They track cost per trip, revenue per vehicle, on-time percentage, claim denial rates, driver efficiency. Every number tells a story. And it matters because decisions based on incomplete data make it harder to improve, grow, and prove value to partners. When a broker asks why they should increase your trip allocation, what's the answer? We try really hard, doesn't work. Our on-time rate is this, and our claim denial rate is that, wins contracts. Number 12. Poor operators compete locally. Wealthy operators think regionally. One city, one metro area, one set of brokers. That's the entire territory for most operations. Limited market, limited growth ceiling, maximum competition. The operators building real wealth are thinking bigger, much bigger. They know that geography determines pricing power. Operators in Washington, D.C., California, or New York earn significantly more because higher living expenses allow premium rates. Same service, different zip code, double the margin. It's geographic arbitrage. The smart operators locate in high reimbursement states. They target wealthy retirement communities where private pay is standard. They identify areas with aging populations and limited competition. Then they dominate before anyone else notices the opportunity. Number 13. Poor operators treat compliance like a checklist. Wealthy operators weaponize it. Poor operators do the minimum to stay legal. They get the licenses, they file the paperwork, they check boxes, and move on. But wealthy operators use compliance as a competitive advantage. They get certified for specialized services that competitors can't offer, things like bariatric transport, pediatric medical transport, stretcher services. They pursue accreditations that unlock premium contracts. Number 14. Poor operators reinvest nothing. Wealthy operators build equity. If every dollar comes out of the business, then there's nothing left for vehicle acquisition, technology upgrades, driver training, market expansion. Nothing for emergencies or opportunities. That's why wealthy operators reinvest strategically. They allocate profit to vehicle acquisition, technology upgrades, driver training, and market expansion. They understand that the business is a wealth asset that can fund lifestyle when managed properly. Number 15. Poor operators think short-term. Wealthy operators build for exits. Poor operators focus on next month's revenue. They make decisions based on immediate cash needs. They have no succession plan, no exit strategy, no long-term vision. Meanwhile, wealthy operators think in decades. They build businesses designed to sell. They view the business as an investment that generates cash flow and requires proper planning for use. They know the answer to the question, what is the cash flow required to live their lifestyle? That being said, the best time to start planning is when starting the company, but there's never a bad time to begin. Wealthy operators start exit planning on day one. Poor operators never start at all. 15 differences. Same industry, completely different outcomes. Poor NEMT operators stay trapped in operational chaos, fighting for margins and working 80-hour weeks for poverty wages. Wealthy NEMT operators build systems, diversify revenue, and create wealth assets that compound. The gap isn't talent nor capital. It's thinking, putting discipline. It's understanding that NEMT is a business, not a hustle. If you're watching from California, the next video is for you. We're breaking down the complete blueprint for launching and scaling NEMT in one of the most lucrative and complex markets in the country. Don't miss it.